doing right now. Put down your coffee, close every other tab, turn off the noise. Because what I am about to show you is not speculation. It is not theory. It is a document released by the United States Department of Justice that proves the financial elite knew about the silver squeeze mechanism 15 years ago, and what they predicted in 2011 is executing right now in 2026. Ladies and gentlemen, Asian guy here, John A.G. It is Wednesday, February 11th, 2026, 2:47 a.m. Eastern Time. And I have spent the last 48 hours going through the Epstein files. Not the flight logs, not the celebrity names, the financial documents, because while everyone was looking for politicians, I was looking for the money. And what I found stopped me cold. In November 2025, the Epstein Files Transparency Act was signed into law. The DOJ has released over 3.5 million pages of documents, emails, bank statements, wire transfers, portfolio statements. The entire world focused on the famous names. But I found something buried in those financial records that connects directly to what is happening in silver markets right now. An email dated May 27, 2011, from a Swiss private banker named Bernard to Jeffrey Epstein. Subject line, Power of Attorney Silver Centropy. Let me read you what Bernard wrote, and I need you to understand that this is not my analysis. This is what the ultra-wealthy were telling each other 15 years ago, while the rest of us were being told silver was a barbarous relic. Bernard writes, quote, I am fully convinced that a squeeze is possible if one can take delivery of 100% of the futures contract. Read that again. A squeeze is possible if one can take delivery. They knew. In 2011, they knew. They looked at the ComEx, they looked at the paper leverage, they looked at the ratio of paper ounces to physical ounces, and they didn't see a market. They saw a fraud waiting to be exploited. But it gets deeper. Bernard continues. I think that silver, without undue speculation, will end the year at $60 and that its inflation-adjusted value is $150. Let me pause here. In 2011, silver had just crashed from $50 to $30. Every analyst on Wall Street was saying the bubble had popped. The mainstream narrative was that silver would go back to $15, and Bernard is writing to Epstein saying the inflation-adjusted value is $150. Not $60, not $80, $150 in 2011. Adjust that for 14 more years of inflation from 2011 to 2026. You are looking at over $220 in today's terms. Silver closed yesterday at $83.33. If Bernard's analysis was correct, and I am about to show you why it was, silver is trading at 1/3 of its fair value right now. But here is where this story connects to what is happening today. Because alongside that email, there is a JP Morgan Chase portfolio statement, the account holder, Ghislaine Maxwell. The document shows that in November and December 2010, 5 months before Bernard's email, Maxwell purchased 3 million shares of First Majestic Silver Corp through her JP Morgan account. 3 million shares through JP Morgan. Let me make sure you understand what I just said. Epstein's financial advisor is writing a detailed silver squeeze thesis. Maxwell is simultaneously buying millions of shares of a pure-play silver mining company, and JP Morgan, the very bank holding Maxwell's account, would later be caught manipulating precious metals markets and pay a $920 million fine in 2020. JP Morgan traders were convicted of spoofing, placing thousands of fake sell orders to drive the price down, then canceling the orders and buying at suppressed prices. They did this for 8 years. Multiple traders went to prison. The head of JP Morgan's precious metals desk was found guilty of racketeering, not securities fraud, racketeering, the same charge they use against organized crime. So here's the picture. Epstein's network is discussing a silver squeeze based on physical delivery. Maxwell is buying silver mining stocks through JP Morgan, and JP Morgan is simultaneously manipulating silver prices downward through spoofing. If you wanted to accumulate a massive position before a squeeze, what would be the ideal scenario? You would want someone suppressing the price while you buy. Now let me show you why Bernard's thesis matters today, because his core argument was simple. If someone takes physical delivery of 100% of the futures contracts, the market squeezes. In 2011, ComEx had enough inventory to cover contracts. In 2026, that is no longer the case. As of February 5, 2026, ComEx registered silver inventory sits at 103 million ounces, down from 167.7 million ounces in October 2025. That is a 38% decline in just 3 months. March 2026 open interest represents 429 million ounces of silver. The coverage ratio is 4.16 to 1. For every ounce of physical metal available for delivery, there are 4.16 ounces of paper claims. Under normal conditions, that is fine. Most contract holders roll forward or close positions before delivery. But when physical shortage becomes visible, behavior changes. More holders stand for delivery. They want the metal, not the paper contract, and that is exactly what is happening right now. January 2026 deliveries totaled 49.4 million ounces. That is 7.27 times higher than January 2024. This occurred in a historically minor delivery month, indicating buyers are securing physical metal before March. February 2026 delivery rate, 98%. Out of 19.11 million ounces of open interest, 18.72 million ounces have been called for delivery. This is not a functioning futures market. This is a physical allocation mechanism. The inventory drainage rate has accelerated to 785,000 ounces per day. If this continues through February 27th, which is March 1st notice day, only 85 million ounces may be available. If March 2026 sees even 25% of contracts stand for delivery, ComEx would need 107 million ounces. Potentially more than will be available. Bernard's thesis from 2011 stated, "The squeeze requires physical delivery. We are watching it execute right now, not by billionaires, by nation-states. China is implementing export controls on silver. The United States classified silver as a critical mineral. Both superpowers are racing to secure physical supply. Sovereign buyers do not get margin called. Sovereign buyers do not care about short-term volatility. Sovereign buyers take delivery," which is exactly what Bernard told Epstein was the key to the squeeze. But let me address the other prediction Bernard made. He wrote that the gold to silver ratio will fall under 20. Right now, with gold above $5,000 and silver at $83, the ratio is 60.41. To get to 20, silver has to outperform gold by a factor of 3. If gold stays at $5,000, silver goes to $250. If gold goes to $12,000, silver goes to $600. This is the endgame scenario Bernard described 15 years ago. Now let me show you why 2026 is different from 2011. In 2011, the buyers trying to squeeze silver were retail traders and small funds. They could be flushed by margin increases. And they were. The ComEx raised margins 5 times. Silver crashed from $50 to $30. The weak hands got wiped. But Bernard recognized that the fundamentals didn't change. The supply deficit didn't change. Industrial demand didn't change. Only the leveraged speculative positions changed, and he was right, because here we are 14 years later, and silver is higher than his $60 target. The fundamentals won. They just took longer than anyone expected. In 2026, the buyers are nation-states. China is taking physical delivery. India imported 200 million ounces in January alone. Central banks are accumulating. These players do not get margin called. They cannot be flushed. Let me connect all the dots for you. In 2011, Epstein's financial advisor identified the exact mechanism for a squeeze: take physical delivery. In 2010, Ghislaine Maxwell was buying millions of shares of silver mining stocks through JP Morgan. In 2020, JP Morgan paid $920 million for manipulating precious metals markets. In 2023, JP Morgan settled for $75 million, specifically for their banking relationship with Epstein. In 2025, the United States classified silver as a critical mineral. In 2026, China implemented export controls on silver. Right now, ComEx and Shanghai vaults are draining. Silver lease rates are at 4.5%, indicating extreme physical stress. The market is in backwardation, meaning buyers are paying a premium for immediate delivery over future delivery. Every single condition that Bernard described as necessary for a squeeze is now present. Not partially, not theoretically, actually present in the data right now. And here's the validation that proves Bernard's analysis was correct. First Majestic Silver, the company Maxwell was buying in 2010, closed yesterday at $23.49 per share. The stock is up 364% from its 52-week low of $5.09. It hit a high of $27.90 this year. That 3 million share position Maxwell bought for approximately $41,000 in 2010. At today's prices, that position would be worth over $70 million. They weren't guessing. They were positioning based on a thesis that is now proving correct 15 years later. But here's what nobody noticed. In January 2021, 10 years after Bernard wrote that email, the Reddit community Wall Street Bets attempted a silver squeeze. Millions of retail traders tried to buy physical silver and silver ETFs. The movement trended worldwide. Silver briefly spiked to $30, but it failed. Why? Because retail traders were buying SLV, which is a paper ETF. They were not taking delivery. They did the opposite of what the thesis required. The information about how to actually do it was sitting in Epstein's emails the entire time, and nobody had read it yet because the files had not been released. Now in 2026, the buyers are not making that mistake. China is taking physical delivery. The United States is stockpiling through Latin American supply chains. Central banks are accumulating. Everyone has learned the lesson that Bernard articulated 15 years ago. Physical delivery is the weapon. Paper is the distraction. And here is one more detail that should make your jaw drop. In 2011, the year Bernard wrote that email, JP Morgan held 0 ounces of physical silver. 0. By 2017, just 6 years later, JP Morgan had accumulated over 133 million ounces of physical silver. More than the Hunt brothers held when they tried to corner the market in 1980. The same bank that was spoofing silver prices downward was simultaneously accumulating the largest physical silver position in modern history. They were suppressing the price with one hand and buying with the other. Now let me explain why Bernard's thesis has not changed. It has only gotten stronger. His squeeze requires physical delivery. ComEx delivery notices are surging right now. January delivered 49.4 million ounces. February is at 98% delivery rate. Large buyers are standing for delivery instead of rolling contracts. His thesis says margin hikes only flush weak hands. We just watched it happen. Silver ran from $37 to $121 in January. Then ComEx raised margins from 5% to 8% to 11% to 15% to 18%. The price crashed to $64. $39,000 contracts wiped. But here's the critical data point. Lease rates went up during the crash. Backwardation got deeper. The weak hands are gone, but the physical market is tighter than ever. His thesis depends on a supply deficit. In 2011, it was a small deficit. In 2026, we are in the 5th consecutive year of deficit, and it is growing. Solar demand has doubled. Electric vehicles, 5G infrastructure, AI data centers. None of these demand categories even existed in 2011, and his inflation-adjusted value of $150. Adjust that for 14 more years of inflation. You get $220 to $240. Silver is at $83. If his analysis was correct, and the directional call has been dead right so far, silver is trading at roughly 1/3 of fair value right now. Let me give you the current battlefield. Silver closed yesterday at 83.33. Gold closed at 5,088. The gold to silver ratio is 60.41. London Vault data from January shows silver inventories down 0.3%, while gold inventories rose 0.6%. The divergence tells you everything. London gold inventories are growing, London silver inventories are shrinking, and this is happening precisely when silver just recovered from its worst single-day crash since 1980. That 0.3% monthly decline in London Silver Vault holdings may sound trivial, but in a market running its 5th consecutive annual structural supply deficit, every incremental drawdown compounds the tightness. Physical silver is increasingly difficult to source at spot. The paper price might say $83, but try to get 10 million ounces delivered in 48 hours at that price. You cannot. The real price is what you pay when you actually need the metal, and that price is diverging dramatically from the paper quote. Bernard's email ends with one final prediction. He writes, "It is also likely that the gold to silver ratio will fall under 20. Under 20. Right now the ratio is 60.41. To get to 20, silver has to outperform gold by a factor of 3. If gold stays at $5,000, silver goes to $250. If gold goes to $12,000, silver goes to $600. This is the endgame scenario. This is the wealth transfer Bernard was positioning Epstein for 15 years ago. This leak changes everything. It validates every single thing we have been fighting for. The silver squeeze is not a Reddit meme. It is not a YouTube trend. It is a strategy that was developed by the financial elite to exploit the banking cartel's vulnerability. The mechanism Bernard described is now being executed not by retail traders, but by the most powerful governments on Earth. And they are not doing it to make a trade. They are doing it because silver is a strategic resource critical to solar panels, electric vehicles, semiconductors, military technology, 5G infrastructure, and medical equipment. The demand is structural. The supply is declining. And the players are no longer weak hands that can be flushed by margin calls. Now let me show you what happens next. Because Bernard's thesis tells us exactly what to expect. He said a squeeze happens when buyers take 100% delivery. We are watching that execute. ComEx inventory fell 38% in 3 months. The drainage rate is 785,000 ounces per day. If this continues, March faces a delivery shortfall. When inventory cannot meet demand, exchanges have 3 options. Option 1. Increase margin requirements to force position liquidation. Make it more expensive to hold contracts so fewer people demand delivery. This happened in 1980 during the Hunt Brothers squeeze. The exchange changed the rules mid-game to protect shorts. Option 2. Offer cash settlement at a premium to physical delivery. Tell contract holders, we will pay you $90 per ounce to settle in cash instead of demanding metal. Some accept, but those who really need physical metal refuse. Option 3. Declare force majeure and suspend physical delivery temporarily. This is the nuclear option that destroys market credibility, but prevents systemic failure when the exchange simply cannot source enough metal. All 3 options are bearish for the paper market's legitimacy, but bullish for physical prices. Because once the market realizes that paper contracts cannot be converted to physical metal reliably, the paper price becomes meaningless. The physical price becomes the only price that matters. And that is when $83 paper silver trades at $120 plus physical silver permanently, not temporarily, not as a premium during shortage, permanently, because the 2 markets have disconnected and cannot reconnect without massive price adjustment. This is exactly what Bernard predicted. The squeeze creates a 2-tier market. Paper trades at one price, physical trades at another, and the gap widens until paper becomes worthless. Now let me address the skeptics, because I know what you are thinking. This is just another conspiracy theory. The market will figure it out. ComEx will never default. Let me show you why that thinking is wrong. The thesis that this was a conspiracy theory just got destroyed by the Department of Justice releasing the documents. This is not speculation. This is an email from a Swiss private banker to Jeffrey Epstein laying out the exact mechanism. The smart money saw this coming. They just saw it early, and now the rest of the world is catching up. Slowly, painfully, but inevitably. The Epstein files gave us the blueprint. The blueprint shows that the financial elite has known about this vulnerability for 15 years. They positioned for it, they accumulated while suppressing prices through spoofing. They waited for the conditions to align, and now those conditions are here. Let me give you the action framework. If you hold physical silver, do nothing. You already own the scarcest asset in a supply-constrained market. Every day that ComEx inventory drops confirms your thesis. Every vault drawdown validates your position. The paper price is noise. The delivery data is the signal. If you are considering buying, understand what you are actually buying. Paper silver through ETFs, futures unallocated accounts might give you price exposure, but it does not give you metal. Physical silver costs more due to premiums, but it is what you can actually hold when the paper market fails. Bernard's thesis tells you that physical delivery is the weapon, and ComEx data tells you that delivery demand is overwhelming supply. The window to convert paper to physical is closing. China sees it. That is why they implemented export controls. The United States sees it. That is why they classified silver as critical. Central banks see it. That is why they are accumulating. The question is, do you see it? Or are you going to wait until the mainstream media tells you it is time to buy? By the time they tell you, the delivery restrictions will be in effect. The premiums will be 50% over spot. The wait times will be 6 months. The opportunity will be gone. Bernard told Epstein in 2011 that the squeeze happens when you take delivery of 100% of the futures. We are watching it execute right now, not by one billionaire, by multiple nations simultaneously. The weak hands have been flushed. Open interest on ComEx collapsed from 176,000 contracts to 137,000 after the January crash. The leveraged cowboys have been wiped out. What remains is strong money, patient money, sovereign money, the kind of money that takes delivery and does not sell. Let me connect the final dots. In 2011, Bernard identified the mechanism. In 2010, Maxwell positioned in silver miners. In 2020, JP Morgan paid fines for manipulation while accumulating 133 million ounces. In 2026, every condition for the squeeze is present. ComEx inventory, 103 million ounces and falling. March open interest, 429 million ounces. Delivery rate, 98% in February. Drainage rate, 785,000 ounces per day. China, export controls implemented. United States, silver classified as critical. India, 200 million ounces imported in January. Physical premiums, rising globally. Lease rates 4.5% indicating shortage. Backwardation, buyers paying premium for immediate delivery. Every piece of the puzzle Bernard described is now in place. The thesis has not changed. It has only gotten stronger. The mechanism is the same. Physical delivery. The fundamentals are the same. Supply deficit. The pattern is the same. Weak hands flushed. Strong hands accumulate. The only thing that changed is the scale. In 2011, it was private wealth positioning. In 2026, it is sovereign wealth executing. The people in Epstein's financial orbit saw this coming. They just saw it 15 years early, and now you have the same information they had. The question is, what are you going to do with it? I am John A.G. The elite knew the squeeze mechanism in 2011. The DOJ just released the proof, and what they predicted is executing right now. This is not conspiracy. This is documentary evidence from the United States Department of Justice. The email reference number is FA01165353. The JP Morgan Maxwell Portfolio Statement reference is FA015520520542. Go look. Screenshot them. Save them. Because this is the kind of thing that gets memory hold when the news cycle moves on. And while you are there, ask yourself one question. If the people in Epstein's network were analyzing a silver squeeze in 2011 based on physical delivery mechanics, what do you think they are doing now in 2026 when every condition they identified has been met? When nation-states are executing the exact playbook they described? When the weak hands have been flushed exactly as they predicted? When inventory numbers are worse than anything they could have imagined? The smart money saw this coming. Now you do too.